Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, Mullen Automotive, as well as Tesla. Starting off, we're going to talk about the recent turmoil that could be ahead of SoFi Technologies, so I want to make you aware of this information if you are a SoFi Technologies investor. However, on the flip side, we will also be analyzing a very bullish positive article that says that SoFi Technologies has great upside for the year of 2023. So we will be comparing and contrasting both of those articles. On top of that, we will also dive into and analyze an article about Palantir Technologies and how the CEO is planning on hiring more employees throughout the year of 2023 to fuel their overall company expansion. After that, we will dive into Mullen Automotive, ticker symbol MULN, and talk about what came out regarding their 10-K form, which shows their overall financials and if this company is a good buying opportunity as of right now. Lastly, we will wrap up the video talking about Tesla's TSLA shares and how a Goldman Sachs analyst actually cuts his overall price target and price prediction for the company, but overall he is very bullish on this overall stock. So without further ado, go ahead and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into it. SoFi Technologies essentially is a digital bank which currently trades for just $5.40. Professionals believe this company should be worth at minimum $5 over the next 12 months and at maximum around $10 over the next 12 months. The article we will be analyzing today predicts their Q4 revenue results for the Q4 of 2022, which he believes is going to come in around $426.5 million. And overall, that would meet Wall Street's estimates, which is pretty bullish and positive for the overall company. Now, despite this, he does believe that this company is overvalued, especially if we can compare them to their competition in this particular space. And he says that investors who are risk averse may want to just hold or avoid this company altogether. So let's look at his evidence for this particular stock. He says that as the next earnings report approaches, investors need to monitor SoFi's products count and their overall membership growth, and this will provide us some insight to forecast what this company could be worth and what they plan to sell over in the future. If their overall earnings report beats expectations by a large margin, we should see the overall price increase, but many professionals just believe that they will meet expectations. Now, this author does highlight SoFi's invest and money products have grown at a very aggressive rate over the last few quarters, and this could lead to an overall earnings beat. But to get a full picture, we need to dive into all three of SoFi Technologies' revenue segments, which would be their financial services segment, their technology platform segment, as well as their overall lending segment. If you're not familiar with this company, SoFi Technologies makes the majority of their revenue from their lending business, which accounted for around 67% of total revenues last quarter. So clearly, by them issuing personal loans, student loan refinancing, and home loans, this company will continue to have lending as their dominant revenue source. But in the future, they want to diversify themselves within their other revenue streams to hopefully increase the amount of revenue that they are bringing in for their technology platform as well as their financial services segment. Speaking of their technology platform, the author believes that this segment will slow by around 5% sequentially to around $80.5 million. And he says this mainly due to negative macroeconomic factors, and I actually agree with him on this point. If we go over to SoFi's financial services, he actually believes this will decrease by 20% in Q4, which would have them bring in around $58.7 million for this segment, and for their technology platform, they're going to bring in around $80.5 million for that segment. But overall, their lending business is still coming in strong by meeting expectations by bringing in roughly $300 million. So what does this mean for the overall share price? Well, in their upcoming earnings report, if the author's projections and forecasts are correct, we could anticipate that the company will bring in around $426.5 million for Q4 of 2022. This would fall directly in line with Wall Street's revenue estimates, which span anywhere from $420 on the low end to $435 on the high end. Right now, the company is trading at roughly 3.4 times its overall 12-month trailing sales, which is not necessarily bad considering their overall growth rate. Now, the next article we're going to be analyzing is in direct direct opposition to the article we just analyzed by saying that this company is actually undervalued and not overvalued. However, the first author does believe this company is a good holding opportunity right now, but he doesn't want investors to overexpose themselves to this particular company, which I 100% agree with. However, on a more bullish note, this author believes that the company is around 50% undervalued, particularly if we compare them to their competition. He believes that this company is still a long-term investment opportunity and that they are growing at an extremely rapid pace. So let's see his evidence for this. Also, of course, all of the resources and sources for this video will be linked down in the description if you want to read these full articles for yourself. So let's compare SoFi Technology to some other companies such as Affirm Holdings, Fidelity National Information Services, American Express, Mercado Libre, which I absolutely love, Block, Visa, MasterCard, and many others. So right now we're going to be focusing on SoFi's technology platform segment, which is growing their overall revenues year over year by around 68.79%, clearly leagues above any other company on this list besides probably Mercado Libre, which is another favorite stock of mine. However, if we compare SoFi's technology platform segment with a 68.79% growth rate year over year to the average of the industry, which is only 22.69, while the industry has a forward price to sales ratio of 5.58, clearly SoFi Technologies can be looked at as undervalued. The author believes that SoFi Technologies should at least have a price to sales ratio of around 7 times, which would be appropriate according to his analysis. This would mean that the market cap of the company would be close to around $7.648 billion, which means that this could provide upside potential for investors of around 51.5%. Now, I do agree with him here. However, I don't think this surge in their overall share price will come while the overall macroeconomic environment is performing quite poorly. Clearly, the overall stock market is not doing very well, so it would be very odd to see SoFi Technologies surge at a time like this. But overall, clearly this could be a long-term investment to hold over the next 5 years as long as you don't overexpose yourself. If you all know me, I don't overexpose myself more than a 5% initial allocation to a particular risky growth company like SoFi Technologies, which is why right now I only have around a 4% allocation to this company because I don't want to take on unnecessary risk. But overall, depending on what analyst, professional, or author you look at, this is clearly a mixed bag to whether or not SoFi Technologies will surge in the year of 2023 or once the overall market recovers. And for me personally, I believe it will surge once the overall economy recovers. Next up, we have Palantir Technologies, ticker symbol PLTR, which is a big data and analytics company that serves both commercial enterprises as well as government clients. Right now, the PLTR share price trades for $6.80, while professionals believe at minimum it's worth $4.50, and at maximum it could be worth $15 over the next 12 months. We had a Reuters author recently comment on Palantir Technologies and their overall hiring spree, despite macroeconomic uncertainty in the overall economy, and honestly just worldwide. The US software company, referring to Palantir Technologies, is expected to hire hundreds of people during the year of 2023, thus hiring the overall amount of employees they have, which currently number around 3,500 staffers. The company is absolutely prepped for war, political upheaval, and an overall downtrend in the economy. Palantir landed a plethora of new contracts following Russia's invasion of Ukraine, and Palantir continuously sells their overall software to visualize an army's position as well as help enterprises vet their supply chains to reduce costs. So overall, Palantir is in a rapidly growing industry and market. However, right now, technically, the company is overvalued according to their various accounting ratios. Now, with that being said, the CEO of Palantir, who is Alex Karp, said that the company is doing very well in the United States, the United Kingdom, as well as Canada, despite a slowing economy. But don't get it wrong, Palantir is still feeling the heat from this downtrend in the overall macroeconomic GDP. Because according to the CEO, Palantir's customers, particularly its top clients, have priorities to reduce their overall spending on cloud computing, and Palantir is actually currently partnering with Cloudflare Inc. to monitor such usage of various cloud computing technology within their current client base. So overall, Palantir is well positioned, but I wouldn't anticipate that this company is set to pay off anytime soon. So again, this would be another long-term holding opportunity, while the overall share price could fall lower considering the negative macroeconomic and negative stock market environment that we find ourselves in as of right now. The next company we're going to talk about is Mullen Automotive, ticker symbol MULN. And this is an electric vehicle startup company that recently filed their 10-K form, which allows us to look into the company's various financials. Right now, the current share price is trading at just 26 cents per share, but overall, if you all know me, I am not bullish on this company, and I am not investing into this company unless they prove themselves either by becoming profitable, actually delivering vehicles, or proving their overall business model. Now, the reason why this 10-K form is so important is because Mullen was extremely late in filing this. However, they did file it before the 5:30 p.m. deadline last Friday. So let's look into the 10-K form, and I'm only going to highlight a couple things that we can get from this overall 10-K form. So first, let's look at their overall pre-orders. According to their 10-K form, they had around 2,890 pre-orders, which means they have around $289,000 in refundable deposits. Essentially, customers are pre-ordering Mullen's new Mullen 5 electric vehicle, and to pre-order the company, you only need to put down initially $100. So at minimum, we have 2,890 pre-orders and people who want to buy the Mullen 5 once it actually enters mass production and is being delivered, because as of right now, it's not. The company also mentioned that the pre-orders had quadrupled on the second day of their tour, so essentially, they're driving their Mullen 5 around and visiting different states to show people the Mullen 5 and how amazing it is. That means we can assume that their pre-orders have increased to around 11,560 pre-orders, or just above $1 million in overall refundable deposits, according to their 10-K form. On top of that, Mullen had total assets on their balance sheet for the year ended September 30th of $302.59 million, with around $92 million of that being attributed to goodwill, which is an intangible asset. So honestly, we could probably discount that, but that's not a lot of money on their overall balance sheet, and I'll tell you why. Mullen is looking to take on a lot of overall debt in the future, and there's only really two main ways that Mullen can stay afloat without going out of business. Either they're going to have to take on additional debt, or they're going to have to raise equity by diluting shareholders. So right now, the share price is just 26 cents per share, but they could continuously dilute shareholders, and that's honestly my greatest fear, which is why I'm not in this company as of right now. I would much rather wait for this company to prove themselves and not dilute shareholders, and then invest in this company once they have proven themselves. Also, another thing that I don't really like about this company is that the CEO received around $6.37 million worth of compensation, and he received an additional $30.07 million due to a CEO Performance Award, which gave him access to 107.9 million shares. So overall, this is way too much money for a startup electric vehicle company CEO to be making. And that's why I plan to steer clear of this overall company, at least in the short term, until the company proves itself. Because I'm definitely open-minded about this company, and I could invest and I would invest, but the company really has to show their value to me before I invest with my hard-earned money. Lastly, we're going to talk about Tesla, which currently trades at $127 per share. The TSLA shares, according to professionals, range anywhere between $200 on the low end and $436 at maximum over the next 12 months. Tesla's TSLA shares have dropped as of late down to the amazing discount of just $127, and this is mainly due to various price cuts, which has then caused Wall Street to issue new price targets. Particularly, we will be diving into a Goldman Sachs analyst who has reiterated his price target. However, I would say he's quite bullish on this company still, as am I. The analyst says that the price cuts of their overall vehicles is concerning for the overall company, but Tesla had to do it due to the reduced demand in the United States. Now, on the flip side, these reduced prices for their overall vehicles will increase the volume at which Tesla can sell their vehicles, and this will also increase demand, which is going to play very favorably into the hand of Tesla regarding their Gigafactory. Because Tesla's main competitive advantage, besides first mover advantage in technology, is their manufacturing capacity due to their amazing Gigafactories. The analyst goes on to say that this higher production rate of cars, which is going to increase the overall volume and hopefully keep up with demand, will allow for more monetization opportunities or more ways that Tesla can make money off of their consumers. This would mainly be due to high margin software packages which you can buy with the company, and if more people are buying Tesla vehicles, this is just going to strengthen Tesla's hold on the overall market, because clearly Tesla is a market leader in the electric vehicle space. any increase in volumes is going to be a net negative for any of their competition. For instance, Tesla's Model 3 and Model Y stack up very well against their competition. If we look at the Mustang Mach-E, the electric Cadillac, or the electric Hyundai, we can see that the Tesla Model Y not only is extremely competitive in their overall new price points due to discounts in this company, but in regards to overall range and acceleration and overall technology, their vehicle is just flat out superior. Just look at the acceleration speed and the technology behind these vehicles that you can get at a cheaper price. So with that being said, the analyst maintains a buy rating on Tesla's stock and their TSLA shares, although he did cut his price target from $205 down to $200, but still $200 is substantially higher than the $127 that their current share price is trading at. So I am also very bullish on this company, and I will start to nibble at this company if it drops below $100 per share. So I would love to hear your thoughts down below. Go ahead and smash that like button for more stock market news updates on any of these companies. Subscribe if you are new, and I will see you in the next YT video.